Look at what's happening.
Good morning, Nikunj. Yeah, thanks for having me on the show. I think, yes, clearly after 23rd, the sentiment had turned, I can say, quite positive. But what has played out after that, one after one, the accidents which were happening earlier are not finding any, I can say, a conclusion which is positive for the market. So right from, as you were rightly mentioning about starting from IL&FS to DHFL to the Yes Bank saga to in fact even Jet Airways, I can say that there are so many accidents happening even within the Nifty stocks that you go outside and look at what's happening to mid caps and small caps. The consensus trade after the election results, after the thumping victory that the government got, I think the clear mandate was to buy mid caps and small caps, which has not played out. In fact, if you look at the last 1 month trade, a lot of mid caps and small caps, in fact, because of the prevailing liquidity situation and whatever the FIs want to put in money, of course, we have seen not great inflows, but whatever they want to buy market leaders, or they want to buy something among the top 5 or 10 stocks, which probably has been the story in the last 1.5 years, and that has continued even after elections. So now what we are seeing is again a polarized market. Mid and small caps probably not going up. Now people expecting something from the monsoon. People also expecting that government would come up with stimulus in the form of consumption boost for the budget. There would be something which would be put in the hands of the consumer, something in the hands of the farmer. How they would find a solution to the NBFC crisis. I think all these are questions which are unanswered. So yes, markets are temporarily experiencing sort of a jolt in the wake of no good news. Trade war also, as you rightly said, is also an impending issue with India. But yes, one thing that crude probably trading around 60 is a bit of positive, and the next 5 years we have a stable government in place. It's again a positive. So my sense is yes, this can be a correction which can still last for 3-4% more. But yes, you have to find your opportunities in this type of correction.
We are addressing the entire HDFC AMC move, where they have decided to use their own balance sheet to give liquidity to some of the unit holders of FMP. Dhirendra Kumar, this is unprecedented. Good morning, firstly, Dhirendra. But this is unprecedented. If I'm a unit holder, I would say HDFC AMC is a messiah, and they're using the old balance sheet to bail me out. But if I'm a shareholder of HDFC AMC, I'm going to ask a question, which is that, look, I did not sign up for this.
No, not really, One, that it is not unprecedented. There have been similar instances in the past where AMC had to take it on its books. And yes, this is significant because this is likely to be a contingent, slap of nearly 500 crore. But it is not, there are two ways of looking at it. One is that if HDFC is able to do, one is the legal issue around it, that they might be under regulatory pressure that why did you do this collateral lending? Are you permitted? Or, it could get into a regulatory issue, or regulators might be asking that were you within your rights to do this kind of lending? That's one issue. The other is that the AMC decided not to exercise its right to sell the shares, which could be to the disadvantage. So that is another thing which regulators might ask. Second is that, as a result of this, HDFC might lose half its annual profit, or 2/3 of its profits. But at the same time, they will be able to build a moat around it, because this is something which no other AMCs can do. No other AMC can do, or a few other AMC can do. And that apart, this is mutual fund is a reputation business. So if you have to take such a thing on the way, it's okay.
2008 also, I remember when it comes to the Subiksha case, some AMCs did bail, investors out. But is this the right way, Dhirendra, for an AMC? I mean, if I'm a unit holder, I would say, look, I've got protected because I've invested with HDFC. But you don't know where this entire NBFC crisis would move. This is not the end of the problem. This could be a prolonged issue which could, just prolong for another couple of quarters.
Yeah, this is something which can actually open a can of worms. Principally, I agree that mutual fund is a pass-through. All the profits and all the losses should be transferred, should be investors. It can't be a situation that profit is investors and losses will be AMC. But this is something, as I was telling you, that the regulatory framework, whether they were permitted, did they exercise diligence in selling the securities, or at the same time, these are the kind of liabilities. If it turns out to be a 20,000 crore position, how will an AMC do? So you never know what could be the scale of it. Yes, HDFC AMC in its wisdom and given the circumstances has chosen to do this, which might be good, which might be disadvantageous to the AMC in the short run, but I think in the long run it will benefit them. This is definitely setting a wrong precedent. Bad credit it should be all investors. A mutual fund is a pass-through. It might be setting a wrong precedent.
So much for taking our time and speaking with us this morning. Investors did want to hear out from you. In fact, let's take that discussion forward. Pankaj joins in with a note that Morgan Stanley's written on HDFC AMC. Pankaj, how are they taking to the news?
So they have not done any major changes to their target price at this point of time. Yes, they have given an update regarding this particular news flow by saying that they maintain their overweight, and this is something which they want to track. They have not commented on it by saying whether the investors will take it on a bad way or in a good way, but probably just looking at the overall thing, they maintain their target price of 2,000. That's in and around where the target price, that's in and around where the current market price is, and probably they are saying that this is something which should not be taken as a precedent going ahead. That every time this happens, this will happen. That's one statement probably which they are telling their view, that this should be treated as a one-off. But let's wait and watch, because they have not given a decisive EPS cut or an upgrade on the basis of this news flow.
All right, thanks so much for that, Pankaj. That's the big news we're tracking for you this morning as well. So an overweight coming in from Morgan Stanley on the same. We've also got a few stocks in focus this morning. Remember, yesterday it was quite a heavy day when it came to some of those metal counters, quite a rout that we saw across the board there. In particular, JSW Steel, that's one that we were looking at with the kind of cut that it saw in trade. And on the other hand, of course, the one odd stock that actually stood out in trade was perhaps in Apollo Tyres. Some element of a block deal which you don't have too many details on, but perhaps that's what led to that surge in the stock, and it was one of the few that was actually moving. But JSW really seeing a bit of a knock, and not the only one across the board, in fact, in the metals stack.
Devang, do you track JSW Steel? I mean, for the longest time, bulls have defended this one by saying that, look, this is a converter, and if you buy a converter, you don't run the risk of commodity cycle.
In fact, yes, it's been one stock which has sort of always not followed the trend, rather. So the sense here is that probably the times are now such that globally also there is a big slowdown which everybody is facing. And while we talk about rate cuts, which is good for the liquidity situation for us, but overall, if you see through the slowdown, I think it's very difficult for such cyclicals per se metals to do very well. So if you look at a lot of numbers of, say, Tata Steel or even other metal counters, I think it's going to be increasingly difficult to justify how they would sort of go up from here. Valuations, and of course, if valuations don't go up, even the price points would be difficult to go up. So my sense is, yes, JSW can probably defy the trend for some time, but we wouldn't like to touch metal counters at this point, looking at the global volatility. A lot of domestic-centric plays are getting inexpensive by the day, and probably if there is a correction which we experience in the next, I can say, 1 month or 2 months, there are a lot of domestic-centric stories which would appeal to us rather than anything which is more global or where we don't have the wherewithal to understand it in a sort of a sound manner.
Apollo Tyres. Now, Apollo Tyres, we are talking at a time when we know there is a painful and a visible slowdown in the auto sales. Auto sector is slowing down. Everyone in a sense is feeling the heat. In the last 1 year, Apollo Tyres has taken a knock of about 26%. If you compare Apollo Tyres with, let's say, Seat, or for that matter, if you compare Apollo Tyres with an MRF, the fact that they've had the global exposure, which sometimes has been, which in a good global growth environment has worked for them, but in a very choppy global environment, I think that whole thing has been, painful for them. MRF is down 26% in the last 52 weeks. Seat is down 28%, and Apollo Tyres also down 26%. So the thing with tire stocks is that even though they try to differentiate themselves, market hardly differentiates themselves when it comes to the price action. Devang, tire stocks, if somebody buys them, should one focus on the bad news coming from autos or good news coming from crude and good news coming from the raw material side?
I think here is a time where you are seeing auto stocks getting hammered. Auto ancillaries, of course, is a story which depends upon the auto, and it's sort of played as a proxy when you see that the auto sector is doing well. My sense here is, why not take direct exposure to auto stocks which have seen huge correction. Just not recommending, but just giving examples for companies like Maruti, for companies like Eicher. The world's not coming to an end. Of course, I know there are problems, and the statement would look a little more superficial in the prevailing slowdown where we have seen the last 6, 7, 8 months of big demand slowdown, and 1 quarter more can probably be a little bit of a extended slowdown. But my sense is, a company like Maruti or a company like Eicher who own market share in their respective sort of segmentation, I can say that why not buy this when they are getting inexpensive by the day. Of course, there will be time when auto ancillaries would also play out to be larger stories, but a lot of these tire companies, as you rightly said, are also dependent upon the global demand. Of course, the OEM demand has been slack. The replacement demand probably does not slow down big time. But my sense is, yes, to answer your question, first we would buy the auto stocks for a couple of years horizon, and then something in the auto ancillary. Yes, couple of tire stocks will look good here also. Even some auto components which have seen huge correction, companies like Endurance Technologies also look quite sound for a 2-3 year horizon.
My heartiest congratulations to ET Now.